Here's Bear Bull Trader's disclaimer. As always, we recommend that you seek professional advice before determining whether trading is right for you. So how do we use our trade book? Remember, our trade book is the combination of our technology, our strategy, and our psychology, right? That creates the trade book. What creates a trade book edge or produces the results we want is the execution of that trade book. And we get there through the process of making sure that we select the right stocks, we have the right confirmations before we enter a trade, we execute that trade within our design plan, and then at the end, we take a look at our trade, review, see where we can improve, what we did well and what we didn't do so well to see how we can improve that. And if you execute that trade book properly, it should produce you a positive equity curve. If it does not, then you want to go back into your trade book and look at re-evaluating aspects of it to see what is not working. So let's go through each of these steps. First is the selection of stocks. Here we start with our gappers watch list. Every morning you see Carlos and Norm start selecting stocks, going through and identifying what stocks are good and what stocks aren't. So we're looking for stocks that gap up or down, right? At least 2% for the most part is what this gapper's there. But for you, it may be different. You may not like stocks that gap up past 10%. Maybe you don't like stocks that have gapped down more than 5% or 9% or 10%. Maybe you don't like stocks that are right at the 2% mark. It's what happens is you need to identify what you trade well so that you can look for those types of stocks and then disregard stocks that you don't trade well. Right? Then we have our news catalysts. When we identify these stocks, the next thing is, does it have something that is causing it to gap up or down, or is it gapping with the market? Now, we don't necessarily care what that news catalyst is because we're intraday traders. We just want to make sure that that stock is gapping up or down off of a news catalyst that's causing that. And we want to somewhat know what it is because there's certain news catalysts like buyouts or stock buybacks or a secondary offering that don't provide great opportunities for trading, but they may gap up or gap down significantly. But with that type of news catalyst, they just don't perform very well during the intraday. So we want to be aware of it, but we don't necessarily care too much about the details like a fundamental trader would. Then we got, next thing that we're taking a look at is the float. And this is important. Here you'll notice everything is above 50 million. That's because the scanner puts a limit on 50 million. It's because I personally do not like stocks that trade below 50 million. It's not a personal preference. It's a equity account preference. My equity account does not like stocks under 50 million. I tend to go in a negative equity slope when I start trading too many stocks below 50 million. So I don't even consider them anymore. I got to have at least 50 million shares of float in order for me to trade a stock. And that's what I'm talking about, like I was with the gap up or down. You might not trade stocks that are above 1 billion shares or above 400 million shares, right? It all is personal in how you develop it. So you want to be able to identify what works well for you and what doesn't work so well for you. Next is our average true range. This is stocks. It just basically is evaluating how much a stock is moving within a day from the high to low. There's a in-depth calculation over it, but pretty much it's over the past, I believe, 14 to 17 day average is what it comes down to. What's important about this when you look at it is stocks that have a higher average true range typically are going to move in a greater distance than stocks with, say, 79 cent or a 0.69 cent type of average true range. They're just not going to move as much. And then we got the short float. Really, as long as it's below 30%, you're all right. But anything above 30% is considered pretty high and could affect the stock for a short squeeze. So you just want to be aware of that. Some people do not like trading stocks that have greater than 30% short float. So just consider that in your results when you're doing your journaling and analyzing your stocks. Is there a stock type that you're trading better at? Is it mid float, high float, low float, average true range, right? Or the short percentage? And then the last one's our volume, right? We want to make sure that there's some good, decent volume during the trading day in order for the stock to move. And what I'm going to show you here next is how, after we look at these, we pull the stock up on the chart and there's things we want to see, right? Because it's important that you look at the stock chart. So here's QS. It did hit off that Gapper Scanners. When I pull this up, notice the time frame. We're at 9:20. This is about 8 to 9:20, right, in the morning. So this is all pre-market. When you initially look at this, this kind of looks like the trading day. Volume is pretty decent, sure. It's sporadic in places, but you have a nice flow, not a lot of gaps that are going up or down. This is a good pre-market chart that you're looking at. This right here, as you can tell, is not so good. Notice how same time frame, right? But we're from 505 to 410 cent range, and some of these candles are within a cent. So a lot of computer. Anytime you see this is computer type trading. Notice the volume too. You got a big spike here on volume where the majority of the shares are. Everything else is pretty small. This is not something that you want to be trading when you look into the pre-market. Again, I'll pull up Apple. Here's same time frame, same day. Very nice smooth chart, a lot like QS was. Notice the volume as well, very nice, right? This is another chart that you like to see and what you're typically looking for. And then here's Disney, same time frame again. Notice how we got one large bar or one large price candle and one large volume bar. Everything else is just pretty sporadic, right? And I want to bring this up because when we bring up the relative volume after the market's been open, notice how Disney's relative volume is low. It wasn't there in the pre-market, continued not to be there during the market. We look at Apple, we had almost double, you had 198%, so basically meaning it was double what the relative volume for the average is. And then your QS, same thing. It's almost 4 times what the normal relative volume is. And notice how that pre-market volume kind of indicates what's going to go on. It's not always necessarily the case. Roku is a typical stock as well as SQ that will typically have pretty bad looking pre-market charts, but will then get the relative volume in the afternoon. But you just want to be aware of that as it goes. And then I want to talk about a common watch list. I think Peter refers it to as his permanent watch list. I have this myself. So if you look at these stocks right here, Facebook down to PayPal, I watch these every single day. I will swap them out if I notice them over a course of a week or two of just not ever being in play. I'll remove them off my common stock watch list and plug another one in. There is something to be said about that because you tend to see and are able to view and look at a stock and kind of learn its behavior and its pattern, and you become more comfortable with it. Then down here is my stock list from the Gappers list or other stocks, news catalysts or call outs that came out of the room as well that's there. And remember again, Notice how I said unknown here. This is all my news catalysts that I kind of put down to see if there's something going on with it. Notice here how I put unknown, and that'll come into play here in a couple slides per se. So that's how you determine what stock selection you want. So now how do we identify what we want to see? It begins with those indicators. Remember, those are the things that get you excited, that you sit up in your seat. What are some of those things? Well, it could be the level 2. Maybe you start seeing, even though this BA doesn't have any here, maybe you see a large ask going in, or maybe a large bid. You got a lot of orders in one side. So that gets you excited and you want to pull up BA onto your chart. Or it could be a multitude of other moving indicators or studies that you have, right? You have your moving averages. Maybe you like to see moving average crosses happen. Maybe you like to see spikes in volume bars out of nowhere, right? Well, associated with a certain type of candle or chart pattern that's going on. Or you have the various different studies, right? You got Bollinger Bands, you got Donchian channels, you got volume by price, you got pivot points, you got just a multitude as you look here, right? Stochastics, you got RSI, all these different things. It's what you feel comfortable with, right? So let me pull up a chart with this on there, right? So here's your volume by price, or I'm not sure why I put volume average price, but volume by price study that's there, right? VPA study that's there. Here you got moving averages, the 200's there, the 50. Here you got the 9 and the 20, and then you got your Bollinger Bands that are here. You got your lower Bollinger Band, and this one right here is your upper Bollinger Band, right? Notice how the stock pops out of that. Notice how it drops. And then here's your pivot points. Then you got your volume bars down here. It really, what you're trying to identify with your indicators when you're developing your strategy is you want to be able to look at a chart and you want your mind to be able to process some type of indicator that gets your heart running. So if I looked at this chart, nothing with my strategy really comes up. This kind of does if this was the high of day, right? I'd be excited here because I got a pullback. But you want to be able to see something exciting that gets you to sit up, get your heart rate up. It makes you want to look to see if you want to enter a trade. Now these indicators, they can be many or they can be very, very few. Typically, we recommend 3 to 5 on average for your indicators, but it can be a simple one indicator. But you don't want to get too large because then you're just processing way too much information. Once you get through those indicators, which should take you no more than maybe, I'd say 15 to 30 seconds at the most, because remember, those indicators are just things to get you interested. Your confirmations, on the other hand, those are the things that make you want to take a trade. So it might take a while for those to develop, but they're the same things. They're level 2. They're your moving averages. They're your volume bars. They're your chart patterns. They're the different studies, right? The indicators would get you excited. The pullback or the move down got you excited. The loss of this S4, now you're looking for it to regain the S4, right? But it's going to take a while till it gets in there. The confirmations are those things that you want to see before you get into an entry point. So let me give you an example based off of the strategy that I trade, which is the break of high of day. So an indicator, right? So I'm going to use this based upon this blue line being the high of the day, which is also a daily level. This is a trade that I took on QS that did come off the scanners that day, December 22nd. We're going to use that as the high of the day, right? My first thing that I'm looking for is a pullback from the high of day. Now there's two ways that I get it. One, I look at 1 minute thumbnails, and I can see very quickly when it hits the high of day and starts to pull back from it, or from the high of day scanner that's inside the BBT scanners, or from Trade Ideas. When it populates, I can pull the stock up. The next thing that I'm looking at very quickly is the smooth volume. Then I'm looking, is there a significant level? And what do I mean by a significant level? It could be a pivot level, it could be a daily level, it could be the high of the 8-minute candle or the low of the 8-minute candle, or it could be a 50 or 200 moving average, right? Those are important levels that are out there. I'm just looking to see if that high of day was at some type of significant level. Then I'm looking for the RVOL, is it above 90? Then the last thing I'm looking for is the level 2 stacking. Now, that may seem a lot, but honestly, if you think about it, I can get the alert or see it on my 1 minute chart, pull it up on the high, look at the volume, look at the RVOL, quickly scan the level 2, and look at the chart and see that there's a significant level there. It can be done in a matter of 5 to 10 seconds if it takes me a while to get the level 2 stacking to determine that, right? That's about the longest part. This part here takes me the longest. But 5 to 10 seconds, then I'm already into my confirmations. And this is when I'm waiting. I'm just looking at the stock, waiting for it to do what I want it to do, because the confirmations tell me that this is a high probability trade if these three things happen. One, it begins to punch back up to the high of day. There's no consolidation at that high of day, which is also near a significant level, right? And most importantly for me, there's rising volume into the break. John calls it stepped up volume. I call it rising volume. I just want to see more volume going into that break because there's enthusiasm, tells me there's buyers there. And then I take that entry, right? That is how quick it goes. This right here, 10 to 15 seconds, I can quickly say, hey, yep, I want to look at this stock. This depends on the stock's movement and the price. I've had stocks that I've waited 30 minutes, an hour. Other stocks like this one, I waited a whopping 3 minutes after I did the indicators and it was there and I was taking it. So it all depends on how the stock is moving that day. But I hope that gives you an idea of how to utilize or what the indicators going into your trade book should be and how to utilize them. The execution of the trade, right? That's the next thing, because once you get in, execution is just as important, right? I would have to agree with Norm that your entry point is probably the single most important thing of your trade, because it can really throw your risk to reward off if you aren't getting the right entry that you want, or if you're chasing a stock. It can hurt you more times than not. But your entry signal doesn't necessarily have to be a price level like I had, right? My high of day is a price level. Maybe it's a volume thing that you want to see. Or it's a combination. For me, it's a combination, right? Price level and volume. Or it could just simply be a resistance level or a pivot level. Like here, maybe you want to take the entries on break of R2 for a move to R3, or a move from R3 to an R4 level. It's really up to you, right? But the other thing on the execution of the trade that you want to be aware of is your stop loss. You always want it at a technical level. And you want to give it some room, just in case it comes back and tests. So if we look at this right here, this daily level, if I use that level as my technical stop, you see it wicks down and up. You want to give it some room. This was my actual technical level I was using, this 109.29, which is the high of the 8-minute candle, or what you may hear referred to in the chat room as the tinfoil line, or the TFL line, that right there. And I lowered my stop because I didn't want to get stopped out at that point. I wanted to see if it would test it, then go up. Because notice here it broke up, came down, tested it, then it moved up. I just wanted to give it a little room, right? And you may think, wow, that's like a almost 80-cent little more. Well, yeah, but if you look at the candle size, this 1 minute candle moved almost $7. So this $1 candle really is not that big in relation to it. The other thing you want to consider is your exits. Where do you want to take your partials out? And this goes into your risk management principle. You want to identify that. Based upon your strategy, where do you want to take out? For me, in the break of high day strategy, I take very quick partials because I don't expect the stock to run that much. This stock is one of the unicorns. It literally ran way more than I thought it would and way faster than I thought, so I benefited from that. But I still managed my risk by making sure that I took profits out at my levels. I typically use this right here was a great level, R3 level, because it can reject it. I took it there. Here was my 1-to-1, which I always look to get, right? That's typically my profit target. I got that. Then this, I was leaving this last bit. I wanted to see if I could get it to run to R4. And as you look here, you may say, why didn't you wait till it there? Well, what happened was when it got here, it stalled and it was having trouble. And I actually took this partial on the way down when it dropped because I did notice that it was very extended on the 1 minute. It was really extended on the 5 minute. And I was worried that this candle that happened 2-3 minutes later was going to happen here. And I might end up not even getting out at break even. So I took the last bit off there, doubled my profit for the day and called it a day. Very quick early morning for me, but I was happy. But this candle, I would caution you, right, opens up here, pushed up above 128, and it dropped below 120 within a matter of 5 seconds. That's how quick that drop happened, and that's what I was worried about on this drop right here. So, but that's within my plan, and that's what you need to articulate in your trade book so that when you get into a trade, you're not making arbitrary decisions in the heat of the moment when you're under pressure, because when we're under pressure, we don't make the best decisions possible. It's better to make your plan ahead of time and then execute your plan. The other thing you want to consider is your movement of your stop loss. And what do I mean by that? Not do I move it further away so I can hope and pray that the stock goes in my direction. That's not what I'm talking about. I'm talking if you take a partial, do you want to move that stop loss to break even? If that stock goes past a certain level, you move your stop to break even before you take your first partial in case if it comes back down. It's really up to you and your style of trading and what you feel comfortable with. But again, you want to identify that when you're not under pressure, not when you're in the middle of a trade. Additionally, adds on pullbacks. Does your strategy call for adding? Are you comfortable adding? What are you going to do with your break-even point after you add? All those things are important. Profit targets. Where are you looking to get? For me, on a break of high day strategy and the way that I trade it, I look for my initial stop. I look to get 1R out of it. You may think I'm crazy. I know I go against typically what the risk management talks about, but it's because of my high win percentage that I'm able to do that with this type of strategy, because I'm looking for a break and a pop. I'm not looking for a break, a stall, and a slow move up. I want a pop and I want it quick. If I don't get it, I'm out. And I don't need that stock to come all the way to my break even. If this stock went up, hesitated, came back down, engulfed this, I'm getting out right here. Right as it engulfs this candle, I'm out. I've minimized my risk. I've cut my losses, which makes my winners larger than my losers. So that's advanced type of risk management, and it's also advanced type of trade management strategy. But that's through a lot of analysis, a lot of data gathering, a lot of research, in understanding how I trade and what I'm comfortable trading with. I do not recommend that strategy as you start out. What I recommend is the 1 to 2, but I also recommend that you clearly identify where you want to take your exits before getting into a trade so that you can execute it. And then the final aspect of it is consideration of your results. You want to look at your trading rules for your strategy. Did you follow them? Did you wait for the breakout? Did you maybe one of yours is you don't want to trade wiki candles. You're afraid of being stopped out, so don't be afraid of it. Making sure that your eyes are focused on what you want to be focused on, the last sales price or the time in sales, or maybe it's the level 2. But it's important for you to evaluate how well you executed your rules for your strategy as well as your overall rules for the trading day. And you do that by identifying what you did good, what you did bad, and areas to improve. Because just because you had made some money on a trade doesn't necessarily mean that you executed that trade well. And the opposite is true. Maybe you lost some money, but you executed it well and it just didn't work out. You want to be able to tell your mind that and execute your mind in that. As you notice, I remember to pay attention to that unknown in the news catalyst. What was bad is that stock had to have some news catalyst, because if you remember, it gapped up 13.8%. But I didn't quite go and find out. I didn't do enough research to find out what that news catalyst was. And depending on what it was, it could have hurt me when I ended up trading. So that was something that was bad in that trade that I didn't go. The other thing is I understood my bias towards that stock, because I had a bias that I wanted to trade it because I felt that it was approaching some good levels to trade off of. But I knew I had that bias and I had to address that. And then the last thing I mentioned in the previous video as well, keep track of your best and worst trades. They're great to go back in and rebuild confidence when you had a bad day. When you had a bad trade, you can always look at the worst trade, right? And be like, oh, well, at least I had a worse trade than the one today. If unfortunately you made the worst trade that you've ever made that day, well, then you probably need to go back and look at just your best trades and remind yourself that you know what's going on and you know how. Because it is a daily grind, it is a daily fight, and it can get very monotonous day over day trying to execute. And you can get lost in that daily fight and lose track of the big picture. That's why this trade book is so important, because you solidified what your execution plan is, what you believe will make you money. You've solidified it, you've written it down or typed it. You can print it out, you can hold it in a 3-ring binder, put in some plastic sleeves, look at it every day, pull it up on your computer every day, but you know that you have a plan that works, and that is important. So thanks for watching. If you have any questions of the trade book, don't hesitate, reach out to me at